The trading plan is like a GPS. It helps traders get where they want to go, and it's absolutely vital in the bumpy world of options trading. You never know what twists and turns you might encounter. So, in this episode, we'll learn how one pro trader crafts his trading plans to navigate whatever the options markets throw his way, and how you can too. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Jason Nadek. Joining us here today is Dan Passarelli. He's the founder and chief executive officer of Market Taker Mentoring. Dan has been teaching DIY investors how to trade options for the past 20 years. Dan, it's great to have you here with us today. We appreciate you taking the time.
Jason, it's really great to be here. Thank you so much for having me.
Now, first off, let's learn a little bit more about you as a trader. Can you fill us in on your experience with trading options?
Sure. Well, I graduated college, a long time ago. And I printed up a stack of resumes, knocked on every door of the Chicago Board of Trade building, and got myself a job as a runner on the trading floor, which is the most entry-level position you could get. And from there, I worked my way up and became I found a backer, became one of the biggest traders in my pit, and had a nice career trading options on the floor of the Chicago Board Options Exchange. And a good friend of mine that I actually trained to be a professional trader, he was working for the exchange, and he said, "Hey, they'd like to talk to you about maybe teaching options." And honestly, I wasn't real sure about it at that time. I kind of thought those who do can and those who can't teach. But I went and talked to them, and I ended up giving it a shot and kind of found that was my calling. It was kind of my way of giving back to the trading community, which is something kind of special about that.
Glad to have people like you in the space. So, all right. Now, before we get into our conversation, just a quick note to our viewers. You can subscribe to our YouTube channel. That's TD Direct Investing, so you don't miss an episode of Inside Investing. Now, make sure to let us know in the comments what you think about today's episode and what else you'd like to see us cover on the show. With that being said, let's jump into it. All right, Dan, you've written that trading plans are often neglected or incomplete by novice option traders. So what could go wrong if a trader doesn't bother to create an options trading plan?
Oh, man. If you want to be successful at anything, it's really important to have a trading plan, including and especially trading, because emotions really tend to get in the way. And when you have to make one of those decisions, do I sell it here? Do I buy it here? Fear and greed, they end up kind of taking control, and then you're following their plan, which is not necessarily a great thing to do. In my experience, the more logic factors that go into a trading decision, the better. And the only way to do that is to sort of map it out in the beginning. If this happens, I'm going to do this. If this happens, I'm going to do that.
I really like that you talked about, having an exit strategy. Many new traders, and even experienced ones, right? If you're not necessarily following kind of your rules all the time, plan for a best case scenario. But what about if things go against you? So I really think that's gonna, having an exit price from a profitable perspective, but a kind of downside perspective is going to be a key element here. All right, so now that you've shared kind of the components, let's dig into each step. What are some of the indicators that you'd like to use to help spot trading opportunities?
Yeah, as far as fundamental ones first, because that's kind of a shorter list, I think, for a lot of option traders. First of all, news catalysts. Specifically, finding out when the volatility events are scheduled, because many of them are. When earnings are announced, we know what that date is going to be a month in advance. Fed announcements, monthly unemployment figures, all these like really important dates that can have the potential to move the market. Like, let's get those on the calendar. If I'm an investor, if I'm taking a longer term horizon on my trade, I'm looking at things like PE ratios and earnings trends. Then we move on to the technicals because those are very important too. And there's a handful that I think are really important. I would say the most important is support and resistance. And boy, that's super simple, good old fashioned support and resistance. But it ends up being a map of human behavior. This is where the buy orders were in the past, and they're more likely to be there again in the future. These are where the sell orders were at resistance. That's why the market bounced down, because people were selling it there. We also want to look at trends. Are we seeing higher highs and higher lows, which would be an uptrend, or lower highs and lower lows, which would be a downtrend? Price gaps, moving average crossovers, as well as the relative strength index is one of my favorites. Now, this is where a lot of traders just kind of end the conversation about the different indicators and such they look at. We've got the fundamentals, we've got the technicals. What else is there? For option traders, we also have to look at volatility. And not just when the volatility events are, we kind of covered that in the fundamental section, but also is implied volatility high or low? Is it above or below historical volatility? Is it in the top half or the bottom half of the 6-month range? This gives us an idea whether options are overpriced or underpriced, which guides which strategy we use and ultimately gives us an edge above and beyond all the other things that most traders only look at.
Your plan really sounds like a funnel, Dan. Like we're not just taking a very narrow kind of approach at one stock. We're looking broader and we're kind of working down towards specific events that are affecting one stock. Am I kind of summarizing that in a right way?
Look, any one of those data points can add some value, some edge to your trade, but you could be wrong on any of them as well. So yeah, the more steps down the funnel, I guess, or the more data points that I can put on my side in my favor, the stronger any trade is going to be. So I always want to go through each of those steps, the technicals, the fundamentals, and the volatility, and just make sure I've got it as buttoned up as I can.
All right, so you mentioned volatility, so let's focus in on that as well as market sentiment. How might this influence how you're building out your trading plan?
We want to put as much in our favor as possible. So in addition to really trying to forecast the potential future direction, we want to think in terms of edge. Because let's say I do my fundamental, do my technical analysis. I've got a slight bullish bias over the next 2 weeks. Okay, great. Should I buy a call? Should I buy a debit call spread? Should I sell a put spread? Should I trade a covered call? Should I sell a cash secured put? I can do it a lot of different ways, and really fine tuning and selecting the one that serves you best for this particular situation. It just gives us an extra edge, an extra chance of winning, maybe an extra chance of winning, or maybe a higher reward to risk ratio. And that's really where the volatility analysis comes into play.
Let's say we found a particular underlying stock that looks like a good candidate for a trade. How do you decide kind of which option strategy to use? And then also, when do we want to execute that trade?
A really good sort of simple heuristic is if I'm looking for a big move, I probably want to have long options, because when I'm long options, just outright, I can have unlimited profit potential with limited risk. If I'm looking for a smaller move, I'm going to do kind of one of two things. I'm going to default to what the volatility is. And if the volatility is low, I'm going to do something like a debit spread. If I'm bullish, a debit call spread, because with a debit call spread, I can actually make more on a small move than I would if I just buy the call. Because if the short call, which is a higher strike, if the stock doesn't go through there and it expires worthless, I get to keep the profit on the call and keep the profit on the short call that expires. if implied volatility is very high, if the options are expensive, is another way of saying that, then I'm looking for option selling situations. Like if I'm bullish, maybe a put credit spread so that I can take advantage of that time decay, as well as if the volatility falls back down to where it should go, I can make money. And, that really puts some wind into the sails.
All right, now we've kind of touched on a number of different strategies that you've kind of outlined as we've had our conversation here, and that really kind of really speaks to the kind of the flexibility of options. There's an option trade for all seasons, but why is it important for option traders to have several option strategies that they're comfortable with themselves when they're building their trading plans?
Yeah, it can be really difficult to consistently profit with just one or two strategies because market conditions they change. For example, selling calls like covered calls in just a really raging bull market might not be really profitable overall because the underlying price can just keep going through those call strikes. And if it's a different market regime, if the market's more trading sideways, then that covered call strategy can be fantastic. Um, Likewise, one thing that does work really, really well in up markets, especially when the options are more expensive, when the market's going up and the volatility is elevated, is selling puts. Man, this was funny story. Oh man, this was it's probably about 10 years ago by now, but I remember being at a party talking with a guy, and we're like, "Oh, okay, nice to meet you. What do you do?" I said, "Oh, well, I help people to trade options more effectively." He said, "Oh, well, I trade options." I'm like, "Oh, okay, cool. What do you do?" And this is when the market was just like really steadily going up, just grinding higher for a couple of years. So what is this? Probably puts us at 2012 or something. And so he said, "Well, what I do is I just sell puts." And I said, "Oh, okay, that's great. What else do you do?" He's like, "No, I don't need to do anything else because that works. I've never had a losing month." Said, "Okay, well, yeah, I mean, the last few years, the options have been overpriced. That's good for selling puts. The stock market went up. That's good for selling puts. Okay, everything was kind of working out." And I asked him, I said, "Well, what's going to happen when the market doesn't just keep going up?" He's like, "What do you mean?" And so I just remember like a year or so later, 6 months or so later, the market it kind of sold off a bit. And I thought about that guy and I realized that he definitely had his first losing month and it was probably a really, really big one. So it's really important to be prepared and to have these different tools in your toolbox, because when the market changes, if you don't change with it, you're going to lose.
That story really leads us into a great kind of point of discussion is on exits and maybe position management, things like that. So what are maybe some best practices that could have helped that gentleman about managing his trades, or maybe even going back to his original plan around choosing strike prices and expiration dates to help mitigate some risk?
On the entry, there's basically two things that you care about. One is when I finally execute this trade, what is my break even point? Because that determines my probability of success. If it's a credit spread, for example, do I have a lot of wiggle room where the stock can move around a lot and I can still make money? Or if it's a long call or a debit spread or something, how much does the stock have to move in order for me just to break even? We always want to think about our likelihood of success, but also our risk reward balanced against our likelihood of success. Am I risking 95 cents to make a nickel? Generally, that's not a fantastic risk reward. But I mean, there could be some times where I might risk 80 cents to make 20 cents if the probability of success is that much in my favor.
What about deciding, when to take profit on a winning trade or when to exit something from a losing perspective? Kind of lay that out for the audience.
Again, it depends greatly on the specific type of strategy I'm using, but in general, selling options, I typically aim for 50% of the max profit, because when you sell options, you have a maximum profit that you can get, or maybe 50% of the max profit on half of it, and maybe be a little greedier on the second half, maybe 65 or 70% max profit on the other half if if I feel it's a stronger trade. That said, I found that volatility swings can really quickly turn a winning trade into a losing one. And so that's why I'm much more willing to get out earlier and lock in a profit and not just hold it all the way until the end. In my experience, this threshold tends to lead to a sweet spot of risk. And, that's very, very beneficial. Now, when it comes to buying options, I typically aim for more. 50 to 80% of what I paid for the options is where I would look to get out for a profit. Now, the odds of profitability when buying options is generally lower because time is working against me. When I buy options, I have that negative theta that works against me. So I basically need to make more on these trades and lose less on these trades because my probability of success is worse. We kind of got this inverse relationship. Like, we always think of the inverse relationship of risk versus reward, but we need to broaden that. We need to think of the inverse relationship of risk reward versus probability of success, because those are inversely related as well.
You've also mentioned that you like to model all of your option trades before you execute them. How does that work, and why do you like doing that so much?
The profit and loss diagrams, which is when we model a trade out, that's what we're looking at. And that just really makes it very, very simple for me to say, here's my maximum profit, here's my maximum loss, here's my break even, and here's how this changes over time. If you have an interface on your platform where you can change the number of days or volatility, it just makes it easier to visualize these things. And when I'm planning a trade, planning which trade to select, it can help me choose an option strategy like the optimal strike price, the optimal expiration date, with a better chance of success over ones that might have slimmer odds, that I might think at first blush are the trades that I want to make. But until I model out a few different choices, then I can say, okay, choice A is this, choice B is this, choice C is this. For this particular scenario, choice C is best.
Now, of course, we all are never going to bat 1,000 when it comes to trades and option trades specifically. All those, it's nice to be confident, but we don't want to be overconfident. So now, if a trade's not going in our favor, how do you plan to manage that trade? When it's moving against you.
The last thing a trader ever wants to do is to make a decision in the heat of the moment, once the trade is already going awry. I like to know exactly what I'll do as the trade plays out and under different circumstances, to sort of war game different scenarios. Hey, look, this is what happens here. I'm planning this trade so that it's, and the expiration date is before earnings so that I don't have that risk. But there's consumer confidence report coming out on this day, and that might affect this. What could happen if this happens? What would I do if it breaks through this technical barrier? So to that end, I like to plan my exit before I enter a trade, and know what success looks like before any of these actual events have a chance to even skew my perception, because I know just from years of doing it that I'm not, and nobody's going to make the best decision when you have these other things creeping into your brain. And a really good thing to do, there's a couple of things that I'd like to add to that. I like to place stop losses on outright calls or outright puts immediately after I execute my trade. As soon as I put on the trade, I'm going to put in a good till cancel order. And if it's a single leg option trade, it's a stop loss order and a profit order. I'll just bracket it. One cancels other, good till canceled, and you just kind of walk away. I'll still monitor it as each day passes, but my plan's done. I can't trick myself into thinking, well, I think I was thinking that I would wait. No, I actually put these orders in already. And then I'm not a big fan of using stop loss orders when it comes to spreads, just because things like time decay and volatility come more into play, and the timing of the move comes more into play with vertical spreads. And so what I'll do there is I will set an alert for my risk management plan. Hey, if the stock goes up to here, I'm going to close it. I'm going to take my loss. I'll set it so that I can get it on my phone, or I get an email about it, or I'm usually in front of my platform, get a little but I'll also always have a profit taking order in, because the profit taking order, if I get filled on that, that's great. The reason why I don't use stop loss orders on spreads is because there's two options involved. And so the bid ask spread of an option might be, this wide, where the bid ask spread of a spread is twice as wide, basically, because you have the bid ask spreads of both options. And so you end up getting worse fills when you use actual stop loss orders. So that's why I do the alerts. But the profit taking orders, those are always in good till cancel right after I put the trade on.
All right, Dan, thanks for filling us in on how you craft a trading plan. Hopefully, it gives our viewers a solid foundation for their own option trades. Now, let's put it all into practice with an example trade in TD's Active Trader platform. We're going to be using the charts to demonstrate many of the key elements of the trading plan that Dan laid out for us in our conversation. To begin, let's go ahead and get some indicators up on the chart. I've taken the liberty of already creating an indicator template to speed the process up. So I'm going to go ahead and access that at the top of the page. On the screen, we're going to have 3 moving averages, a 21-day, a 50, as well as a 200. I've also added the RSI to the chart at the bottom. Dan also mentioned using the MACD on his charts. Let's go ahead and get that added in here to our array of different indicators. We can do that by choosing the function button at the top of the page. Now, TD Active Trader has a wide array of indicators and oscillators that you can choose for yourself, well over 100. You can either scroll through the list, or we can go ahead and use the search function at the top. Let's go ahead and drag in the MACD onto our available studies. You'll be able to see at the bottom, there's a chance to edit the parameters of the study, but if we're okay with the default, we'll just go ahead and close that up, and we'll see that that's been now changed. Now, first things first, what I kind of like to see here is trying to help identify the trend. Is this up, down, or sideways? And I think we can see pretty clearly this is a bullish trend. We're making higher highs and higher lows. One nice thing here that the moving averages help to show for us is it's really all about the orientation, right? We've got our blue line. This is our 21-day. It's on top. Our intermediate average, our 50-day, is in the middle, and we've got our long-term average, the 200, at the bottom. When they're in that vertical kind of orientation, that's another telltale sign of a bullish trend. One of the other things Dan mentioned was being aware of different events for the particular company that might alter the volatility. And a couple of those were dividends and earnings. So let's go ahead and get some visual cues onto our chart for that. If we go ahead and click the chart settings gear at the top of the page, and then move ourselves down to the events on the dropdown, and then click show events on chart. Now, what should jump out to us here? We've got these little diamonds, the red and the purple, that are showing to us the earnings and dividend dates for this particular company. And already what it's beginning to tell me here is that on the red diamond, on the earnings, we can see we had a small gap up. Now, the gap up is something that Dan mentioned in his plan, where we've got this blank space on the chart. The price jumped, it gapped up to a new price point, and that happened last earnings earlier in February in the year. And we can see the most recent earnings period towards the middle of May, a much larger gap up has been created. So that's going to kind of maybe weigh on our decision to put support and resistance lines on our chart. So let's go ahead and actually take care of that right now. So our drawing tools are on the left-hand side. I'm going to choose our price line. I'm going to put one price line at kind of where the price kind of consolidated itself
after its previous earnings in February. It kind of moves sideways from that point. But then, once again, as we noticed, there was a significant gap up after our most recent earnings. So let's go ahead and put a line where we gapped up to. So we've got this blank space here. One of the old adages that all gaps are filled in. So that could be something to look for, later on down the road when we've got a trend reversal. But right now, kind of we've got this new established potential line of support. And I'm going to put one kind of more nearer term support line here. The stock is certainly traded up to new highs, but it did kind of pull back ever so slightly. So that might be an opportunity for us to identify a key trading point for us to use right now. All right, so we've got lots going on the charts. Let's now consider, making an options trade on this. So maybe if we're still feeling bullish because of the trend, we're bullish long term, and there might be an opportunity for us to own stock long term. But in the near term, maybe we can make some premium using a short put and it as a strategy. So we've got the chart up in the screen. We know that we had some pullback to around $66. So that could be an identified strike price that we can sell. Nice thing here about Active Trader, we've got many different strike prices that you'll be able to visualize and compare against each other. When we're thinking about selling options, we want to balance the time that we're going to be selling. We want to sell enough that we're going to be getting enough premium back for ourselves, but not enough that we are going to be locked into the trade and giving it too much time to go against us. So maybe we're thinking in the range of 30 to 45 days, but that all could depend based on your own individual analysis and circumstances. So I'm just, for today's example, let's choose the first week of August here, 42 days to expiration. We identified 66 as a potential support point. So if we're thinking about selling puts on that number, it's really, the nice thing to show here is that it's really just simply done by point and click. Okay, we can go ahead and click on the bid price, just as simple as that. We've got our order ticket already drawn up at the bottom. You can see that my default quantity size is 10. If you wanted to adjust that to a smaller trade, that's certainly available to be done, and you've got the ability to change strike prices and expirations in the ticket itself. From here, simply done. We're just confirming and sending. We're getting our order confirmation up on the screen. That shows us a lot of great information. We've got our buying power effects. We've got our profit and loss information. And then from there, it's simply about sending the trade through. You'll get notifications on your screen, and then we'll be into a trade, and wishing everybody the best success going forward.
Just a reminder to our audience, you can learn more about the basics of getting started with options in our past episode. It's called Veteran Option Trader Sarah Potter Shares Her Top Tips for Beginners. It's available in the Learning Center on Webbroker and on TD's YouTube page. Plus, visit td.com/OEM for a full list of educational content about options trading, from video lessons to interactive masterclasses and more. All right, Dan, we're going to have to leave it there. Any final thoughts you'd like to share with the viewers?
Well, first of all, I'd just like to say thanks, Jace, for having me on, and hope that I provided some value.
The pleasure's all ours, Dan, and thanks for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content. It's available in the Learning Center and on our YouTube page. We'll see you all next time. Have more questions? Check out the links to the right and in the description below.